Hello traders and welcome to Backtest. In this video we will be testing a simple crossover strategy. As you can see in the screen, when the EMA 22 crosses above the EMA 222 and we have a bullish engulfing, it's a buy signal. And when the opposite case appears, it's a short signal. So we'll be testing this. We'll be testing this on crypto. Let's select XRP. And then we come to our conditions. So we will select double moving averages. It's 22, so we set the fast moving average to 22. And since we are using a exponential moving average, we will select exponential moving average. And then here in the slow moving average, we will select 222. And again, the type of the moving average will be exponential. The signal is golden cross, and the price is above the fast moving average. And then we will add the candlestick pattern, which is in this case bullish engulf. Now we will pass to the sell conditions. We will select double moving average. Same thing, 22, and then we will select the exponential moving average. Same thing, but the opposite signal, EMA. And then the signal is going to be death cross, and the price should be below the moving average. So death cross and candle. Yep, this is the signal, death cross, and the price is below the fast moving average, which is in this case the exponential moving average. And then for the engulfing, we will select bearish engulfing. The time frame will be set to 15, and we will be selecting the take profit to be 2% and 1% for the SL. Toggle this, and then we will select the default lot size to be 1000, because the XRP is pretty cheap and we have the funds, so we can cover all the trades. Then you press backtest and wait for a few seconds. Okay, this is the result. We have a return of 0.19. It means that it made profits, but because we bought a very small amount compared to the account balance, the return was small. It's not the important metric here. The important metric is the profit factor. This tell you if, for example, you risk $1 to gain 1.29. So it's like the global risk reward metric. And then you have the win rate, 39.74%, which is basically a reasonable win rate when it comes to a strategy that have two profit, two reward against one risk, 2 to 1. So once you increase the stop loss, meaning the margin of the loss, you will notice that there is a increase in the win rate, and vice versa. When you increase the profit margin compared to the loss margin, you will find that the win rate shrinks. And the duration is approximately 60 days. This is the average trade in percent. This is the average profit. And then where is the drawdown? The drawdown, max drawdown is 0.15. And again, these metrics are small because we didn't buy as much or we didn't sell as much. Okay, this is the chart. So as you can see here, this is the bearish engulfing, and it's below the fast SMA, which is the EMA 22, and this is the slow EMA. The red one is the slow EMA 222. So as you can see here, after the bearish engulfing, we entered the sell position. Now we will look for the buy setup. This is also a bullish engulfing, as you can see. Bullish engulfing or bearish engulfing basically means that a let's say a bullish candlestick engulfs a bearish candlestick, and vice versa. It means that it's going to be bigger than the opposite candle. Same thing here, as you can see, guys. Price is above the fast SMA and the fast EMA, excuse me, and the fast EMA is above the slow EMA. And then you have the second condition to confirm the signal, which is bullish engulfing in this case. Now you have the trades history. Let me turn on the trades history. When you see a negative size in the trades history, that means that the trade was a sell position. And when you see a positive size, that means that the position is a buy. So now if we go back and do some edits, like increase the leverage or increase the size, like 10,000. Okay, and then you backtest. Now as you can see, the return has increased.